Hey, good morning. This is Mayor Valensky with Driving Markets. I hope you're well. A good weekend. So today is U.S. American Independence Day. They became independent. For a bit of history, they became independent in 1776 from the British after the 7-year war. There's a bit of history for you. Anyhow, let's go on to where we're at financial markets. So the markets on Friday, they went up slightly in the States at the beginning of the month. So it's the start of the 1st of July. They were slightly up, but they've had the worst 6 months since 1970. 1970 was a major recession. It's not all doom and gloom. You have to remember there is full employment out there, which is a big support for the economy. I mean, it's very unlikely, it's very hard to have a recession when you've got full employment. So keep that in mind when looking overall at financial numbers and financial commentary, including driving markets, because even though sometimes it can sound like doom and gloom, believe you me, there's lots of opportunities within trading and within overall business cycle to make money. It's all not completely dark and grey clouds and it's all over. We do have three factors that obviously are depressing consumer confidence at the moment, and that is interest rate rises, that is inflation, and that is fears of recession. We're not officially in recession, it's just a fear of recession, even though Cathy Wood and a few of the other major ARK and investors and traders on Wall Street are saying that we're already in recession, but we're not officially there, and therefore let's not get too negative and let's try and keep our chins up, because even in a recession, people can make money. So let's look at what is going to be driving markets this week and likely be driving markets over the next few months. The main driver is going to be where the economy is going in light of inflation. I've always stated from the beginning that inflation is not going to stop rising this year. It's going to go much higher, probably to the 12-13% level, even though most views are opposing mine, saying absolutely not. I do see it, official inflation at 12 to 13%. We all know that unofficial inflation is running at 20-25%. Take a simple example of the cost of airline tickets. They've doubled, even tripled in certain circumstances. The cost of food, the cost of travel, the cost of petrol, all of it's well above the 4, 5 or 8% that's been declared by the US, UK or other Western governments. We know that inflation is much higher than that, because the measure of inflation, or the basket of goods that's used to measure inflation, is just too narrow. It doesn't really take into account every expense, but however we are feeling it in our pockets, and there's likely to be further frustration of that inflation when energy prices start to rise again in September, October, November. There's going to be no end near sight to the war between Russia and Ukraine, and if everything could intensify. So where will that leave financial markets? Well, higher risk assets like Bitcoin and foreign exchange are very volatile, and Bitcoin is running around about the 19,400 level, and it just can't seem to break up above the 22,000 level. So it's definitely range bound at the moment, and it's probably a good asset to trade on that particular range until it breaks above the 22,000 or below the 17,500. My view is over the short term, next month, 2 months, it's going to fall below the 17,500. So far I've been proven wrong, it hasn't, but I'm still holding that view. As regards foreign exchange, you've got to be long of the US dollar. Come on, seriously. I mean, the US is just going to go through a cycle of inflation, but more importantly, the US dollar is deemed as a safe haven when it comes to assets or investment. Therefore, it's going to be sought after, and that's one of the reasons why it's gone up against the pound, the euro and the Japanese yen, and against all other majors. So the US dollar is a buy. I've been stating it over and over again. Going on to other sectors, you've got the high-tech sector, which is going to continue suffering. Last week, for example, you had a SPAC, a special purpose acquisition company called Enjoy Technologies, and that was set up by an executive or executives from Apple and JC Penney, the big retailer, and they floated last year on the Nasdaq using a SPAC, and they went bust on Thursday. So all those investors and all those private investors or hedge funds that invested in Enjoy Technologies Inc. in the States, the Californian-based high tech, have lost all their money, and there will be a lot more SPACs going bust. Just to keep in, for your information, because they're very highly speculative and they need huge amounts of cash to keep them going, and that cash is just not available. Liquidity's been taken out of the market, so you're going to have further falls in the Nasdaq and high-tech sector. So keep that into account when you're trading. Oil is going to go up, even though it went down last week on the fears of recession. I still think it's going to go to the 130, 140 level before the summer is out. So I think you should go long of oil. This week you've got the PMI figures in the Eurozone and the UK. That's the purchasing managers index, and in the States you've got the massive non-farm payrolls, which is the unemployment figure on Friday, something to look forward to. Remember, the US is closed today for Independence Day. This is Mayor Valensky with Driving Markets. You can catch me on YouTube, WhatsApp, Twitter, Instagram. Subscribe, stay tuned, and enjoy the videos. Have a good day.